They told you it was a coincidence. They said it was just a normal market correction, maybe blaming a distant central bank or some AI bubble bursting. But what if the biggest financial collapse and liquidation event in crypto history wasn't random at all? What if it was caused by an $18.3 trillion elephant in the room that almost no one saw coming? This isn't just about Bitcoin's price. It's about the structural integrity of one of crypto's biggest corporate buyers, and the decision brewing behind closed doors that could force a $2.8 billion stock exodus. The date was October 10th. The dominoes are still falling. Let's break down the hidden mechanism that just brought the entire crypto market to its knees. First of all, we recommend you hit that subscribe button and turn on notifications right now, because we are breaking down complex financial mysteries every single week. And trust me, you are going to want to know how to protect your wallet in this changing economy. So go ahead and click that button, and let's get started. Think back to the seismic event of October 10th. When the dust settled, over $20 billion had been vaporized in a single, brutal crypto liquidation cascade. More than 1.6 million leveraged traders were wiped out in the first 24 hours. The headlines screamed about leverage, market makers losing their shirts, and a sudden liquidity vacuum. It was horrific. But in the highly volatile world of crypto, a horrific drop usually leads to one thing: a meaningful bounce, a V-shaped recovery, or at least a temporary dead cat hop. But this time, silence. The market hasn't been able to take a single, deep breath of relief since it's been a relentless, painful grind downward. Day after day, week after week. If it was simply a natural deleveraging event, the market flushing out excess risk, it would have found a new, stable floor by now. The fact that it hasn't, the fact that we've witnessed zero significant positive momentum, tells us that the initial shock was only the symptom of a much deeper, persistent disease that continues to drain confidence and capital. This isn't coincidence. This is a deliberate, ongoing, and structural risk playing out in real time. And it's centered squarely on the shoulders of the biggest corporate Bitcoin holder on the planet. I'm talking, of course, about MicroStrategy. For years, MicroStrategy's strategy, raising massive sums of capital, often through debt, specifically to accumulate Bitcoin, was hailed as genius. It was the revolutionary blueprint for corporate treasury management in the digital age. But now, that very blueprint, the innovative structure that made them famous, is turning into the single biggest liability facing the crypto ecosystem. The danger began to materialize, not in a shady DeFi protocol, but in the staid world of institutional finance. And the timing aligns precisely with that infamous crash date. The standard narrative you've been consuming, that this sell-off is purely organic or due to foreign macroeconomic fears, is fundamentally incomplete. The real key to decoding this persistent market collapse isn't found in the Bitcoin chart. It's hauntingly apparent in the long-term stock performance of MicroStrategy itself. Let's zero in on the MicroStrategy stock chart. The trajectory since the middle of July has been nothing short of catastrophic, signaling distress far ahead of the general crypto market sentiment. Since the 16th of July, the stock plummeted by over 61%, shedding billions in market value. And if you zoom in further, focusing specifically on the period since the October 10th crash, the stock is down a massive 50%. The simultaneous and severe collapse of Bitcoin and its most highly leveraged corporate proxy suggests a clear cause and effect. The magnitude of the decline is far too extreme, and the alignment of the dates is too synchronous to be dismissed. This implies that the smart money, the institutional investors privy to high-level regulatory shifts, were already rushing for the exits. They weren't simply reacting to a crypto crash. They were strategically responding to the news that caused the crypto crash. So, what piece of news, delivered on October 10th, had the hidden power to simultaneously trigger the largest crypto liquidation in history and cause the stock of its most famous corporate buyer to effectively halve in value? The answer is a seemingly bland, technical regulatory announcement published by one of the most powerful, yet least discussed, financial institutions in the entire world, the MSCI. To truly grasp the danger we face, you must understand the colossal influence wielded by the MSCI. If the global stock market were a vast, fortified citadel, the MSCI would be one of the three commanders, setting the rules of engagement and controlling the primary entrances. They are one of the world's three largest index providers, standing as an equal powerhouse alongside established names like S&P Dow Jones and FTSE Russell. Their scale dictates investment policy for a huge chunk of global capital. They oversee indices that track nearly $18.3 trillion in assets under management globally. That figure is almost unfathomable. This is the definition of passive money. The pension funds, the sovereign wealth funds, the major insurance companies, and the behemoth exchange-traded funds that are obligated by their very charter to buy and sell whatever the MSCI tells them to. If a stock is included in an MSCI index, massive capital is instantaneously funneled toward it. The demand is relentless, consistent, and automatic. If a stock is excluded, trillions of dollars of passive money are compelled to execute a forced, non-negotiable sell order. The MSCI doesn't just measure the market. They are a critical mechanism that moves the market. And on October 10th, they quietly moved against the core business model of the biggest Bitcoin treasury holder. The announcement was presented as a consultation, a period of deliberation over their index methodologies. But the goal was crystal clear. The MSCI is exploring how to classify and treat companies whose primary business function is not operating a traditional business, but rather strategically accumulating massive treasuries of digital assets like Bitcoin. Specifically, the proposal aims to exclude from their global investable market indices any company whose digital asset holdings constitute more than 50% of its total assets. This technical proposal is, without a doubt, a precision surgical strike designed to target one single company above all others. MicroStrategy. So, why would the index regulators view MicroStrategy as a structural threat that needs to be purged? The principle is fundamental to passive investing. Funds cannot, or at least should not, invest in other funds. When an ETF, which is a fund, invests in a company that operates primarily as an asset-holding vehicle, which is essentially another fund, it creates an inefficient, circular concentration of risk, known as a fund of a fund. Passive investors buy a stock index like the Nasdaq, hoping for broad exposure to innovative technology companies. They are not buying a specialized Bitcoin holding company disguised as a software firm. MicroStrategy's highly effective model, raising capital through complex financial instruments like convertible notes and equity sales specifically to purchase and hold Bitcoin, perfectly fits the definition of an operating fund or a digital asset treasury company. They are not a software company that occasionally buys an asset. They are an asset accumulator that happens to operate a legacy software business on the side. Therefore, in the technical, rule-bound world of index management, they must be reclassified. This single, seemingly bureaucratic reclassification from a tech stock to a digital asset fund is an existential, potentially fatal threat to MicroStrategy's investment thesis and, by extension, to the entire corporate treasury model for Bitcoin. The immediate, quantifiable fallout of this looming decision is staggering. Top institutional analysts, including those at JP Morgan Chase, have wasted no time in sounding the alarm. They warn that should the MSCI proceed with this exclusion, MicroStrategy faces a high probability of losing its eligibility for crucial indices like the MSCI USA. and potentially the bellwether Nasdaq 100. The estimated consequence: a devastating $2.8 billion in passive institutional investment could be forced to liquidate the stock. Picture a financial floodgate. That gate is labeled MSCI Index Inclusion. If the ruling goes against MicroStrategy, that gate is automatically opened. The $2.8 billion is not sold by nervous individual investors. It is sold by soulless, automated algorithms that manage passive funds. Funds which are legally and contractually obligated to instantly dump any asset that falls out of the benchmark index. These passive funds do not evaluate the price. They do not look at the company's underlying value, and they absolutely do not negotiate. They simply execute a massive, structural sell order. MicroStrategy currently relies on an estimated $9 billion of its market capitalization, being held within these passive exchange-traded funds and index trackers. We are talking about liquidating up to 25% of the company's entire stock value in a rapid, non-discretionary cascade. This forced selling pressure would not just hurt the stock. It would instantly decimate the share price, driving it violently lower, potentially pushing it far below its net asset value, the actual dollar value of the Bitcoin it holds. This creates a deeply troubling discount that reflects fundamental market uncertainty. Crucially, the ripple effect doesn't end with the stock price. MicroStrategy's highly leveraged model was entirely dependent on maintaining a high prem stock valuation, fueled by this passive index inclusion. This elevated valuation was the primary energy, the financial fuel, that allowed the company to consistently raise new capital through convertible notes, stock sales, and debt offerings, all for the singular purpose of buying more Bitcoin. If this passive energy source is permanently cut off, the largest consistent buyer of Bitcoin in the corporate sphere suddenly loses its engine for future accumulation. This is the precise moment where the most dominant whale of the crypto cycle faces the risk of complete financial neutering. To understand why this is so critical, we must look to history. The entire life cycle of cryptocurrencies, from nascent bull run to bloody bear market, is ultimately a story of leverage unwinding. Every spectacular market top, every apocalyptic, wealth-destroying crash, can eventually be traced back to an over-leveraged institution or mechanism that inevitably snaps under pressure. In 2017, it was the futures markets breaking. In 2022, it was the cascade of institutional failures, like Terra, Luna, 3, Arrows, Capital, and FTX. I maintain a long-standing view. Every major crypto cycle terminates, not because of fear, but because of a massive leverage bubble bursting. This time, the bubble is not a fly-by-night lending platform. The leverage mechanism is institutional, fueled by corporate debt and equity linked to index inclusion. The treasury company frenzy, championed by MicroStrategy's model of borrowing to buy the specific leverage point destined to end this cycle. The announcement on October 10th and the resulting sustained market pressure acts as the definitive lunar moment of this cycle. It is the inescapable, decisive structural event that forces the market to transition from exuberant expansion to painful contraction. The pain comes not just from the stock selling, but from the realization that an entire cohort of powerful, consistent buyers, the digital asset treasury companies, is now compromised and effectively removed from the future growth equation. Without the reliable prospect of massive, passive index capital, the incentive for every other public company to copy the MicroStrategy model vanishes. The consistent source of institutional high-volume buying is being methodically choked off, leaving the market increasingly dependent on slower, more conventional demand channels, like retail accumulation and governmental adoption. The MSCI consultation period is active until the 31st of December. But the final, binding conclusion that will dictate the fate of MicroStrategy and the entire corporate treasury model is set to be announced on the 15th of January. This date is not merely a financial note. It is the single most critical deadline for the entire crypto market structure in the next months. The market's current, agonizing paralysis, its inability to orchestrate even a meaningful bounce, is a direct, rational reflection of this ticking clock. Why would large institutional capital commit billions to a market rally when a non-negotiable regulatory ruling in January could instantly trigger a massive corporate stock dump? They won't. They wait, ensuring that the market remains in a state of suspended animation, priced for the worst-case scenario. On January 15th, the market faces a binary outcome, a moment of high-stakes financial drama. 1. Favorable decision inclusion maintained. If the MSCI decides to walk back the proposal, or if they craft a specific, acceptable exception for companies like MicroStrategy, the market will treat this as an incredible release of tension. The structural uncertainty would be immediately neutralized. The existential risk contained in MicroStrategy's stock would likely experience a violent surge upward, dragging Bitcoin and the wider crypto market into a massive, relief-fueled rally. 2. Unfavorable decision, exclusion, confirmed. If the ruling confirms the exclusion, the immediate market reaction will be a sharp, panicked drop, as institutional investors digest the certainty of the coming passive fund exodus. This will trigger a subsequent, larger structural crisis for Bitcoin. The final automated dump of up to $2.8 billion in MicroStrategy stock by passive funds will be implemented around February 2026, creating a guaranteed large-scale selling event in the equity markets right after the January decision locks in the corporate tragedy. This forced equity selling will put tremendous negative pressure on the entire Bitcoin price, as the viability of the entire corporate treasury sector is called into question. The current pricing already reflects a strong probability of the unfavorable scenario, but anticipating the final, algorithmic, non-negotiable dumping of shares is critical. This means we must prepare for elevated turbulence, extreme volatility, and sustained uncertainty until the January 15th deadline provides definitive clarity. For every individual Bitcoin holder, the most immediate and terrifying question is always the same. If MicroStrategy's stock collapses, will the company be forced to liquidate its enormous Bitcoin treasury to cover debts or manage shareholder unrest? Here is the essential piece of mitigating information. No, not automatically or immediately. MicroStrategy's core identity and long-term thesis is built on the ironclad, unshakable HODL strategy. Acquire Bitcoin, hold Bitcoin, and never sell Bitcoin. The forced selling that is coming will be of their stock, shares of MicroStrategy driven by external index rules, not of the underlying Bitcoin. This collapse in stock price will certainly sink the shares far below the company's net asset value, eliminating the premium and creating a deeply discounted Bitcoin proxy. It will make raising future capital nearly impossible. But critically, it does not, by itself, compel the company to liquidate its existing Bitcoin holdings. What this outcome signals, however, is the complete and permanent termination of the MicroStrategy energy source. This massive, consistent source of institutional buying power, fueled by index inclusion and high equity valuation, will be extinguished. The capital tap will run dry. That vital energy, the propellant that drove the corporate adoption narrative, will cease to flow. From that point forward, MicroStrategy would transition from being a market driver to merely being a deeply discounted Bitcoin holding company, limited to surviving on its existing treasury, but fundamentally unable to replicate its original explosive growth model through new capital raises. We have peeled back the layers to expose the fundamental truth behind the market's unending malaise since the October 10th collapse. It was not a random market event. It was the calculated, anticipatory reaction of sophisticated capital to a technical yet devastating index rule announcement by the primary gatekeepers of global passive money. The flagship model of corporate Bitcoin adoption, the MicroStrategy strategy, has been structurally targeted for exclusion. The outcome of the MSCI's ruling in mid-January is now the single most important event on the calendar. It will determine whether this risk is neutralized or whether it explodes into a full-scale structural crisis for the crypto asset class. This is not a moment for blind panic or reckless buy-in, but for highly informed caution and strategic positioning. The relentless selling pressure has a clear external financial cause, and that cause has a non-negotiable deadline. Expecting a sustained market rally before January 15th is financially unsound. The optimal strategy is to internalize the risk, track the regulatory process closely, and prepare for massive volatility surrounding that final announcement. The potential collapse of the most powerful corporate whale's growth engine is the final, structural leverage unwind of the cycle. And it is being imposed by old finance, not generated organically from within the new finance ecosystem. This is a head-on collision, and we are witnessing the impact zone in real time. If you found this deep analysis compelling, if this exposed information that the typical news cycle is completely missing, then I urge you to subscribe this channel. Give this video a powerful thumbs up to ensure it reaches more people who need to understand this risk, and share this information across your networks. This is the kind of alpha that allows you to manage risk and position yourself ahead of the inevitable market volatility. Thank you for tuning in, and as always, your safety and financial clarity are my priority. Trade smart. Trade defensively.